Good evening, guys. How are you? Okay, how are you? Are you good? Or how are you doing, guys? Are you doing good? So, what I think is everybody is watching a recorded only. So, I feel that today I wanted to come live. Yeah, Akshay. Hi, Akshay. How are you? Okay, what I want to tell you is that I really want to do live, but then kind of because that is how we had this thing. But then I think you want to watch recorded because exams are nearby. That is what I can understand. So maybe allow me to have that flexibility of maybe today I wanted to do live because I was starting derivatives. Okay, then gradually off and on as so even if I do up to derivatives and kind of your 70% portion would be done properly, 60% portion would be done properly. Correct, na? Good evening, Ankita. Okay, I think major portion of the SFM, which is the tougher part, like bond, equity, then forex and IFM and derivatives, would be sorted. Uh, Good evening. Good evening. Acha, I'll speak two lines in Hindi because there is a student who is asking me something, so I need to speak in Hindi. That is not relevant to you, so don't worry. मैं मेरी फर्स्ट क्लास है डेरिवेटिव्स करने से पहले फॉरेक्स करना ज़रूरी है आज के लेक्चर में तो ज़रूरी नहीं है आज के लेक्चर में ज़रूरी नहीं है इतना ज़्यादा लेकिन मैं क्या बोलूँगी कि मैंने हिंदी में जो अपलोड करे हैं लेक्चर्स तो ये लेक्चर देखने की ज़रूरत नहीं है मतलब आई मीन अगर व्हाट आई सजेस्ट इज़ दैट कि जो हिंदी वाला है ना वो देख के फटाफट ख़त्म कर दे फॉरेक्स है ना हिंदी वाला मैंने 2 फास्ट ट्रैक लिए ना एक मैंने हिंदी में लिया और एक मैं इंग्लिश में ले रही हूँ अभी ओके तो वो वाला पार्ट यू कैन सी जाके सारे ही चैप्टर्स किए वहाँ तो मैंने बिकॉज मेरे पास टाइम I had a lot of time that part of time that when I was doing Hindi. As of now, I had morning lecture from 6:30 to 9:30 in the morning. Okay, I woke up at 5 o'clock. I took lecture 6:30 to 9:30 for Aldine. Okay, and there is a live batch going on for AFM. This subject is now called AFM for further attempts. This is the last attempt for SFM for that matter. Okay, then I rushed to office. Then I took my CFA level 1 batch. बहुत सारे क्वेश्चंस हैं बहुत सारे क्वेश्चंस हैं ओके सो बेसिकली आई टुक दैट बैच एंड देन आई CFA level 1 batch in the afternoon. I came back from the office and then again I have your lecture. So in a day I am getting around 9-10 hours of lecture which is a bit tiring. That point of time in August I did not have any commitment as such. All the batches started now only. So that is I get tired at times and I'm not able to reach home in time because Bombay has lot of traffic. Oh, Dheeraj Sharma, okay. So thank you Dheeraj, thank you so much. So ठीक है शुरू करते हैं let's start. I feel whatever it is. So I felt many times you feel okay just drop it. I mean I cannot go beyond. It's tiring. But then again I feel no I want at least derivatives I want to do because derivatives the students would be like waiting for derivatives and interest rate risk management, so I didn't want to ditch you on that part. Rest then remaining mutual funds and mergers you can manage on your own also, you don't need my help as such. Okay, but yeah, derivatives is something you definitely need my help and did not want to leave you in between like that. Oh Sushmita, please आ जाओ, please आ जाओ. Okay, आ जाओ पहले पढ़ लेते हैं उसके बाद बहुत सारे क्वेश्चंस कवर करें बहुत सारे क्वेश्चंस कवर करें सुष्मिता सो बट आई कैन नॉट स्पीक इन हिंदी इफ़ यू वांट टू सी हिंदी का तो प्योर हिंदी बैच ऑलरेडी यूट्यूब पे इट्स देयर people can go and watch them. That was like every day 2 hours we were doing but I was very comfortable time wise but then I felt that derivatives I can't ditch. Derivatives and interest rate risk, forex and derivatives are chapters where students really need help and I am sure maximum of you would be waiting for the lecture to happen because it was derivatives. Correct all of you? Yes Mansa, good evening. Oh, Padmavati, thank you for coming today. Now, start. So, derivatives. I always start with a story here. Okay, the story is that we feel that we are the people who do not like too much of like, for example, people. It is a connect part actually. It is nothing good or bad, Hindi, English. It is just a way of communication. Okay, people can communicate with signals also. I mean, they can, people who cannot hear, people who cannot speak, they are still able to communicate. So, as far as I am able to reach you and you are able to reach me, it's we are fine. Okay, it is not, so communication can be with the help of eyes also. So exactly, I don't mind Hindi or English. By God's grace, I have equal control on both the languages actually. So people who are more comfortable in Hindi, that means they have a better connect in Hindi, must watch the Hindi lectures. They are really good. They are there on the YouTube only. You can go and watch them. Rather, you will enjoy maybe more. And if you are fine with English, you can stay back with me. I don't mind. So maybe they are. Oh, thank you so much. Thank you so much, Sushmita. Then, okay, derivatives. So we feel at times we are the sophisticated people and we know something about derivatives. No. Since thousands of years, since human being has been able to understand risk as in uncertainty, since the times the human being started feeling that there are rains, there are floods, there are something which he cannot control, he would be always wanting to hedge. So derivatives story did not start today, it started way thousands of years back. Since human beings started having some sense of managing the risk, they started feeling uncertainty. For example, you know, imagine the human being is able to like understand, okay, every year there are rains, every year there are winters, every year there is, you know, kind of summer and so on so forth. So when he saw repeatedly for some number of years, he could understand the pattern and he started hedging himself. Okay, so this is like way back, like very 10,000 years back maybe, I'm telling. Since then hedging thing is there, and since then derivatives have been there. I will not get into that kind of very historical story or very old story, but yeah, something to start with. Derivatives first started with commodities. People did not know about stocks and bonds 5,000 years back or 4,000 years back for that matter. Okay, people knew that, okay, agriculture is dependent on monsoon. Okay, today I am able to sell wheat, the flour, the bread, the chapati, that you eat, wheat, WHEAT. Okay, I don't know how many students are able to understand all this in today's times, I really doubt. Okay, so that way, so suppose there is a farmer. Now I'm going to the story. Okay, there is a, it is a just created a story, I'm cooking up a story basically. So there is a farmer, okay, and he's, if you would have heard of, I can tell a lot of stories to you, but this is not the time to tell stories. So after the exams, if you are good, come on the YouTube, we'll speak stories. Are you coming? After the exam, we can have a story session wherein I can share multiple, we have to choose a topic and I can have, I mean, so many stories that you will just keep on listening, anything you want to listen. You want to listen on Mahabharata, you want to listen on Ramayana, you want to listen on something else, you want to listen on politics, you want to, what do you want to, you want to listen on stock market, what do you want to listen? So we can have lots of story sessions here wherein I speak and you listen, you speak and I listen. Okay, that way. Chalo, coming to the topic again. So maybe there is a farmer. There are small markets in small villages. They are called hats, HAATS, where everybody, every household produces something. Some produce like clothes, some produce wheat, some produce rice, some produce pulses. All of them come together in a common area. They are called hats or markets. The way you have malls today, okay? And now this time, this year, there is a middleman coming from a semi-urban area, maybe in that sense, and asking the farmer, what is this wheat per kg? He says 50 rupees per kg. I've kept the price a bit relevant. Otherwise, it would be something like 1 paisa or something like that. So we will not be able to relate with that. Okay. Then he says, okay, give me 100 kg because I have to deliver it to a flour mill. Okay, fine. So 50 rupees into 100 kg makes it to 5,000 rupees. Okay, he gives the money, takes the delivery of the wheat and goes away. But then he again thinks he is scared, the farmer is scared. Why? The farmer is scared to the fact that if next year the monsoons are like too much monsoon, there would be increase in the supply of the wheat, and as a result of that, what will happen? The price of the wheat will go down maybe 40, 30 something, and he is feeling he's having a sense of uncertainty. Similarly, the middleman is thinking that if the monsoon is less, then the supply of the wheat will be less, and as a result of that, what will happen? The price of the wheat will go up maybe 60, 70, whatever. So both enter into some kind of contract wherein both promise each other that again next year this guy will come buy 100 kgs of wheat at the same price, rupees 50 per kg, irrespective of the fact that what is the price prevailing in the market. What kind of contract is this? What kind of contract is this? Can you tell me, please? What kind of contract is this, guys? Speak. What kind of contract is this? A forward contract. Yes, a forward contract. Yes, 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 correct. It is a forward contract. Can you imagine? So there is no scripting of such kind of contract, but this contract in terms of sentiment is there, right? Okay, okay. Thank you so much. Now, coming to the topic again from the examination point of view, there are 4 types of derivatives that you have to study. Number 1, forwards, futures, options and swaps. Okay. So forwards. In your subject, you have to study, you know what are you supposed to study? OTC. You have to study forwards and you have to study swaps. Under this, you have to study forwards on currencies that you already did in forex and interest rate. Okay, interest rate that you are going to do in interest rate risk management. That means this topic is in a way done, because in the CA curriculum, okay, they are wanting you to do forwards on currencies that you already did in the forex chapter. It is very important to streamline your subject, that what is the portion that is there in the examination that you have to study. See, that this topic derivatives is something I can teach you every day for next 365 days, it doesn't get over. But then we have to bring it under our control by making it structured. You just can't study open-ended. Okay, this I have to study this. Okay, let me study. Okay, I have to study this. No, that's not a good idea. Rather, you have to say, okay, what I have to study? I have to study 4 kinds of derivatives: forwards, futures, swaps, and options. Okay. Pen marks not visible. Okay, fine, fine. Got it, got it. Is it visible now? Is it visible now? I feel it is visible now. Yeah, so it is interest rate risk management. Okay, now the next set of swaps is again IRRM. These two are again interest rate risk management. Okay, what are interest rate risk management? Interest forwards on interest rates that you called FRA. You call it FRA. I'm writing very dirty. Okay, so this is called FRA. That means FRA and swaps you have to study under IRRM, not in derivatives chapter as such. Okay, though you cannot study FRA and IRRM, study FRA and swaps without understanding derivatives. So if you say, I can make a better chart, actually this is very dirty and I think most of you are losing out on that part. I want to give a very, very proper chart. Where should I do? Here. Give me a second. So maybe like derivatives can be segregated into 2 categories depending on the place of their trade. One is OTC, over the counter, and one is your like exchange traded. So how do I distinguish between the two? Suppose I want to have some biscuits. Okay, I go to a maybe like some, there are small shops where you have some tea and some biscuits and everything. So you tell that guy, that shopkeeper, okay, that packet, Parle-G packet you have, please break that packet and give me 2 biscuits. Will he do that? He will not do. He says that you want to eat 1 biscuit, you want to eat 2 biscuits, you will have to buy the whole packet. I don't break it and give. Rather, there is a jar where all the biscuits are there. You can pick up one from there. So that jar is basically your OTC market, where contracts can be customized as per your requirement, whereas that packet is your exchange traded, where even if you want to have 1 or 2 or 4, doesn't matter, you'll have to take the whole packet. That is exchange traded. So we can segregate your derivatives into two depending on the place of the trade. One is like OTC. So in OTC, 2 products are OTC. One is forward and one is swap. Okay. Then exchange traded. Exchange traded, again they are futures, and then we have options. Okay. Now you have to study in the CA final, you have to study on forwards on interest rates. Okay, that is called FRA. Okay, and then you have on currencies. So this is already done. This is already done in the Forex chapter. This you will do in the interest rate risk management chapter. This you will do in IRRM. Done. This forward thing is done. We are completely sorted. That means one is done and one we will study in the next chapter. Then swap, again you will have to do in the IRRM. Why? Because, so basically I tell you something. What happened in 2018 when these people changed your curriculum? You need to understand the structure of your portion also. In 2018 when they changed your portion from SFM to new SFM, then what happened? There we used to have only one chapter, derivatives. Derivatives can be on any underlying. It can be a stock, it can be a bond, it can be a currency, it can be a commodity, it can be interest rate also. So what I understand is that whatever is uncertain in the future, the prices of anything for that matter whose behavior or the results are uncertain in future, which I cannot decide today, you can have derivatives on that. For example, if you are betting on cricket match, it is a derivative. It is a derivative. That contract is basically a derivative, because the results of a cricket match cannot be predicted with 100% certainty today. You can have a derivative. That is why people bet on that. Okay, somebody is long, somebody is short. So I am long on India, you are short on India. So the moment India-Pakistan match starts, there is so much of betting out there. Okay, so if I feel that India will win, that means I am long on India. You feel India will lose, you are short on India. So basically during the match, if the position of India is improving or it is better, I am winning and you are losing. That's how it works. So derivative can be on anything, the underlying, and hence derivative does not have its own value. It derives its value from the underlying. So if the underlying is a gold, then it will behave like a gold. If it is rice, it will behave like a rice. If it is a wheat, it will behave like a wheat. If it is a cricket match, it will behave like a cricket match. I hope you understand now that the derivative does not have its own value, it derives its value from the underlying. So if you have a derivative on interest rate, then it will behave accordingly. And after 2018, they divided this derivative chapter into 2 parts. One was derivatives and one was interest rate risk management. So all the derivatives, whether it is a forward or it is a future or it is an option, which are based on interest rate, are given in one chapter, that is called interest rate risk management, because interest rate behaves in a very typical manner, kind of, it is unlike a stock or a bond. Okay, I am sure guys you are able to understand that part. Now futures, you have to study futures on stocks, you have to study futures on commodities. Okay, and your futures on currencies as well. Futures on interest rates are real tough topics. I have not seen CA final curriculum asking anything on this part. Futures on, so you have forwards on stock, you do not have forwards on stock. See, when I say OTC market, who is the player in the market? A bank. A bank. Currencies are available with a bank. Okay. Now swap contracts are not traded on exchange, they are available with a bank. So it depends on the place of trade. Since stocks are not available with a bank, how will you have a forward on a stock? Do you agree with me? when a stock is not available with a bank, okay, then how will you be able to have a forward on a stock? It is not possible, okay, that way. Now, futures are not with the bank, they are on the exchange. I hope you are getting the whole idea what I'm trying to tell you actually. So you have to study futures on commodities, futures on currencies, and futures on stocks, 3 categories, all traded on exchange. Then options you have to study on currencies, options you have to study on stocks, options you have to study on interest rate also. They ask question cap, floor and collar are options on interest rate, but again you have to study that in interest rate risk management. This is the whole structure of the topics that you have to study. Now, ideally what are we supposed to study then? You can ask, ma'am, then tell me what I am supposed to study. Okay, you are going to study here forwards, actually it is done. Then future, mainly futures and options. Look at this, I have written here. Mainly in this chapter you are going to study futures and options. Can I write like this? I think better. Futures maybe like 9:30. So futures on stocks, then you have futures on currencies, and then you have futures on commodities. You have futures on interest rate, but then they are not tested in the paper. Then again options, so again you have to stocks, then currencies, and then you have on interest rate, which will be taught again in the interest rate risk management. So just for the sake of starting the topic, I have given you forwards. Look at this. A forward is a promise to buy or sell any asset on a particular date at a pre-specified rate. A forward is an OTC product, and banks play a very important role as market maker. The most commonly traded in the forward market are currencies. It provides good opportunity to exporters and importers for hedging their exposures like a payable or a receivable in a foreign currency. Exporter, importer. Did you not see one thing very common, that currencies are traded on exchange also, and currencies are traded on forward market also? Okay, do you know that? But why? There are 3 types of people in the market. One is a hedger, one is a speculator, one is an arbitrager. If you understand the behavior and the psyche of all these 3 people, you will never go wrong in the chapter called derivatives, because either they will ask you a question from the perspective of a hedger or a speculator or an arbitrager for that matter. Who is a hedger? I have imported goods worth $1 lakh from the market, okay, on 1st of January from US basically. Okay, I have to pay $1 lakh after 3 months, okay. And I import garments and sell in my local market. I did not go to the market intentionally, but the very nature of my operations are such that I have to face the risk for that matter. I will have to face the risk. Okay, so I am a hedger. I have not gone to the currency market to make profit or loss for that matter. I want to hedge myself. I want to maximize my inflows and minimize my outflows. Who is a speculator? I feel dollar will go up against rupee. I don't have any buying, any payable or receivable in real terms. I don't have anything. So if you feel, if you have a view, if you have price belief, okay, bullish or bearish. So if you think dollar will go up against rupees, buy dollar. If your belief turns out to be true, you will earn money. If it doesn't, you will make a loss. And when you make a loss, you should be able to bear it. And hence, a speculator must have a risk appetite also. Okay, then only you can become a speculator. Third, arbitrager. 1 market, 2 markets. Same example I gave always. NSE, BSE 2 market. Okay, 1 stock is 100. The same stock is trading at 110 in the another market. 1 stock, 2 markets, 1 point of time, 2 different prices. Not a good idea. I don't like it. That means that stock is not trading fair value. Okay, so there would be an arbitrage opportunity wherein people will start selling the stock at 110 and start buying from the another market at 110. Okay, sorry, 100, and you will make a arbitrage profit of 10. But because of this process only, the market will come back to the equilibrium. It will again move out of the equilibrium, and the same process will bring the market back. So the psyche of these 3 people are very different. If you read a sum, you will be automatically, immediately be able to understand, okay, this question, he is a hedger, he is a speculator, he is an arbitrager. So try to identify that, things will be much easier for you. Okay. From where did you pick up this word, Mansa? P note? I need to know the context actually. I'll tell you, don't worry. Okay, so now here an importer imported goods worth $5 lakh on 1st of Jan, maturity 31st of March. He is afraid of dollar going up and hence he buys forward at 70.05. On maturity he pays and receives $5 lakh. The spot on maturity is 72, but the hedger could get at 70 only due to the forward agreement. I just have, it was not required, this example was not required, okay, but then I gave so that you can have a smooth start. Now moving on to the futures and going back to my story again. So what happened, next year came and the monsoons were very good, and as a result of which the supply of the wheat increased a lot, okay, and the price in the market went down to rupees 40 per kg, okay. My question to you is that who will default? The middleman will default, okay, or the farmer will default? Who will default? If they had entered into a contract at rupees 50 per kg, but in the market it is available at 40 rupees per kg, who will default? The middleman will default, right? The middleman, yeah, the middleman will default. So if suppose in my example, if you would have like the middleman will default, yes. So maybe like in our example, suppose maybe like, you know, kind of, if the farmer would have asked what was the contract value, 50 rupees into 100 kg, 5,000 rupees. If the farmer would have asked for 2,000 rupees, okay, would the middleman would have default? No, he wouldn't have default. That is what we are talking about in futures, okay. So there was a lot of counterparty default because of the absence of a formal contract, okay, a legal contract, okay. And that is how the sophistication, with the markets getting more and more sophisticated and more incidences of like counterparty default, this thing was introduced in futures. And there's a typical feature of future that is called margins. Margins are nothing but the guaranteed deposit that the buyer and seller have to do before they start trading. So in order to avoid counterparty default, the margins were introduced. Futures are traded on exchange. You have futures on commodities. There is exchange called MCX, okay, in Bombay, where commodities are traded. Anything you can imagine of with respect to natural like natural products like wheat, rice and all the pulses and the crude oil, bullion, gold, silver, platinum, everything you can imagine of, you know, it is traded there. That's called MCX, okay. You have futures on commodities, you have futures on stocks, you have futures on bonds and T-bills, you have futures on interest rates also. So you have futures on everything basically, okay. The futures are nothing but they are sophisticated form of forwards. The only difference between a forward and future is that forwards are not traded in the market. When you and I enter into a contract, that contract remains like private to both of us, whereas in futures that contract is traded in the market on an exchange, okay, and there are margins associated with futures, but behaviorally both of them are same, okay. Now look at this. Futures are sophisticated form of forwards traded on exchange. The contracts are standard in terms of quality, quantity and maturity, okay. They are marked to market on a daily basis. Okay. Second, mark to market and types of margins. In order to avoid counterparty default, the exchanges stipulate margins, which is nothing but a form of guaranteed deposit. There are three types of margins: initial margin, maintenance margin and variation margin. The price of question, guys, are you fine, all of you? I will show you some example here. Can I show you some example here? Look at this. I'll show you the margins part so that you don't have to like struggle unnecessary, that I don't like actually. Okay, I'll write here. Suppose, how does it behave actually, the futures? Okay, suppose we buy one futures. It is not allowed to buy one future, you have to buy in lots. How does it matter? But mathematically, we buy one future at a price of rupees 1000. Okay, initial margin is 500. Same example, 300. Okay, now day 0, 1, 2, 3, 4 and 5. Okay, now futures price is suppose 1000 plus minus and closing. Give me a second please. Okay, so 1000 suppose, and you deposited 500 of initial margin, because the exchange will not allow you to trade without margins. Okay, now because if you incur a loss, you will run away the way the middleman ran away, and then it will lead. What would have happened to that farmer? He would have invested his money throughout the year in order to like cultivate wheat for that guy, and the guy did not turn up only. So it is a loss. In order to avoid such kind of losses, this is given, so that if you incur some kind of loss, the counter, you should not be running away. You have to honor your contract. Okay, you cannot make other people suffer. Now suppose the next day the price became dash, the price became 1100, this becomes 100, and this is 600. Okay, then this is 1300, and this is plus 200, and this is again 800. Okay, then you have again, can I write maybe like what, 1200, so minus 100, and this becomes 700, correct? And the market is falling again, this becomes 1000, so minus 200, and this becomes again 500. Okay, 6, 7. Okay, so this is basically 800. No, I will not take 800. 800 is something confusing for you. I want to have 200 actually. For that I need to have a price of 700. 700, then minus 300, and this becomes 200. There should be a margin call here. There should be a margin call here. That means you have to, the moment your account goes below 300, even a single rupee, okay, there will be a margin call. That means replenish the margin account. Okay, and suppose it was not 200, it was 299. Okay, suppose it was 299. A normal person would feel, okay, let me deposit rupee 1. No, you are not supposed to deposit rupee 1. You have to take your account back to 500, because it is an administrative issue, unnecessary, kind of again and again calling the client for the margins. It's not a very, I have worked in the broker houses, and it is not an easy thing. Calling money to fill the losses, it is not an easy thing. So the rule is that the moment you fall, so up to 300, no margin call at all. The moment it falls, even a single rupee below 300, you will get a margin call to bring the account back to 500 and not this thing. So suppose we assume that 300 was put here. So next day, suppose it is 800. This is plus 100. This will become 600. Okay. And suppose again, this is like 1100, for example. So this is plus 300 and this will be 900. So I don't want to trade further. I need to take out I want to close my account. So this is the money I take out. Okay. So what is my profit or loss? This will be 900 minus 500 that I have put. And then again I had put. So I get what? 100. instead of doing so much of calculations, you can do a very easy method. Why not take a difference of between this and this? So you bought at 1000 and you will sell at 1100. So 100 is your profit basically. So whether you go by this or by this. So many questions you will see that you do not prepare a margin account there, and you take the difference of the two future prices. So virtually, whether you take the difference of two future prices or you prepare a margin account and calculate 100, it is one and the same. Are you all good? So again, I am going to my original sheet. Yes. Okay, so let's go ahead now. The price of March Nifty futures contract on a particular day was 9170. Yeah, 9170 should be. There is some typing error there. Okay, the minimum trading lot on Nifty futures is 50. The initial margin is 8% and the maintenance margin is 6%. So what will you do? 9170, okay, into 50. So that becomes the contract value actually, and that into 8% will be your initial margin, and that into 6% will be your maintenance margin. Okay, then they have given the prices, guys. Okay, what are we supposed to calculate? Mark to market cash flows and daily closing balances on account of an investor who has taken a long position, means he bought at 9170. Okay, taken a short position 9170, net profit or loss on each of the contracts. Okay, all good, fine. So the 9170, I told you 9170 into 50 will be the value of your contract. Okay, 8% of this will give you the initial margin and 6% of that will give you the maintenance margin. Okay, for the long position. So basically, guys, you deposited 36, same. One example I write and do, the simplest one, the one we did just now. If you can hold on to that example photogenically in your mind, you can break any question of mark to market sum that they are doing here. Look at this. 36,680 is what you deposited. Next day, the price is 9380. So 9380 minus 9170 into 50, 10,500 you may make a gain. It is added to 36,680, it becomes 47,180. Then again, it is 9520 and so on so forth. Okay, maybe the account became 36,680 here, but you need, okay, I think, give me a, can you use your this calci? I think it is better that you use the calci. Now here, look at this, 54,180. Now 9100 minus, there is a loss of 21,000. Okay, so plus 54,180 will give me 33,180. Okay, 33,180. Till here it is good. Till here it is good. Then again, I cannot go below 27,510. Okay, so 8,960 minus 9,100 into 50. There is a loss of 7,000. So plus 33,180 will give me 26,180. So that means you are falling below your maintenance margin. That means you will not deposit 27,510 minus 26,180. No, you will deposit 36,680 minus 26,180 minus 36,680, and that amount is 10,500. It is given to you. Guys, would you be able to manage this sum? Should I proceed further? In the short position, guys, the guy will go opposite. He would have sold at 9170. He will buy again. Again at that price he sells, he buys again. So basically you will see that it is one and the same only actually, you know. So if it is a loss for the long position, the short position will have a gain. Guys, would you be able to manage this question? Should I proceed further so that we can have quickly we can finish the portion actually? Are you fine, all of you? This is not a very difficult sum. All of you are good? Okay. Okay, the second question. I expect one question maybe of this kind in the examination, because this is a topic which they have not tested quite a lot actually, but I feel that, but that is my feeling only. I feel like coloring everything. The spot price of L&T Limited on 4th of June is 1701, okay, per share, okay, and June futures on this being traded at, guys, they have summarized the whole thing here. So look at this. One column is of L&T share and the another one is of L&T futures. Be very careful. We do not need this at all. We do not need. We need this one. So possibly, let me read the sum. The spot price of L&T is 1701, which I can see here. The June futures are being traded at 1740. I can see here. The lot size is 400. Mr. Rohan takes a long position on this, which is for 6 lots. Subsequently, on 12th of June, okay, this is 12th of June, the spot price moved to 1750 and June futures are traded at 1798, okay. He squares of 2 lots at this price. Guys, what are you supposed to calculate? You know what? You are supposed to calculate the open interest. Now, what is open interest? So, you bought, it is not lost, it is lots actually. Oh God, it is lots. Okay, so when you bought 6 lots, your open interest, again they have written, oh God, it's lots. So basically when you bought 6 lots, okay, then your open interest is 6. Means open interest means non-squared off position. Non-squared off position is called open interest. Are you fine, all of you? Okay, so when he squares off 2 positions here, okay, then the open interest is 4, and then once you have now 4, okay, and then again guys, if you see here, yeah, how many did he sell again? I think there are a lot of typing errors in the question. He squares of 2 lots, okay. I also got confused now. He squares of 2 lots at this price on 23rd of June. Okay, so this is 3 lot actually. This is 3 lot, I feel. Okay, so first he squared of 2 lots, then 3, and then 1, and it is sorted. It is because of typing error, guys, we are getting confused actually. So let me see, give me a second please. This is 2, this is correct. On 23rd June, the spot price for, so when he squares of 2 lots, the open interest is 4, okay. On 23rd June, spot price falls to 1690 per share, and the June futures being traded at this one 1720, which is correct. He squares of 3 lots, okay. This should be 3, guys. This should be 3 actually. Is it correct, all of you? Let me check, because I don't want to leave that 1720 minus 1740 into 3 into 400. Yeah, so this is 3. Please correct it. So after squaring of 3, the open interest is 1 actually, okay, and the last one, when the last one is squared off, then there is no open interest at all. Easy question, very easy question. Now the third topic is fair pricing of futures using a cost of carry model. Okay, yeah, that is 3. I got it. Now there is every chapter you have done till now, every chapter, or you are going to do in future maybe, right? Every chapter will have one thing in common, that is valuation. In equity, you try to value a stock. In bonds, you try to value a bond. In foreign currencies, also you will try to value a foreign currency, rupee per dollar. What should be the price of dollar, where dollar is a commodity? Okay, similarly here, you are trying to compute what should be the value of futures. Okay, I give an example which I always give in the class. So what is the base of pricing a future? The very famous model which is used to price a future is called cost of carry model. Okay, suppose me and Harsha are 2 people and we are into crude refining. Same example I give, I give to the same example because I have perfected this example over a period of years. I am not interested in quoting new examples at all, because when my job is done, it is done properly. Okay, when I start quoting new examples every time, I might get confused, you might get confused. So no point. When the things are perfected, the students understand, it's good. Okay, so we never call it a stale example or something like that. Okay, so me and Harsha are into crude refining business. Okay, we buy crude from the market, refine, and we into petroleum and diesel and whatever we do, and we sell in the market. Okay, after 3 months I would need 1 lakh barrel of crude. After I'm standing on 1st of Jan, Harsha standing on 1st of Jan. Both of us would need 1 lakh barrel of crude oil on 31st of March. I cannot plan buying 1 lakh barrel on the day I need. I have to plan it earlier, okay? So Harsha is a very, very risk averse person. She says, okay, I don't want to take any chance because it is related to my business. Okay, so I will buy today only, Jan 1 only. So she buys 1 lakh barrel of crude, suppose at $50. So 1 lakh into 50 gives me 50 lakh dollars she had to pay. 50 lakh, that means $5 million she had to pay. But I decided to go long on crude futures, wherein I enter into a promise to buy, no money change. Assume, okay, I will deviate a bit for a second. Cost of carry model is a model, a theoretical model, and this model assumes no transaction cost like brokerage, commission, taxes and margins also. So when we would be talking about cost of carry model calculation, quite a few times it will come to your mind, why am I not considering the margin? Because margins are transaction cost, and in a model we ignore the transaction cost. We assume we all are honest. Okay, so there is no margins, nothing. Okay, fine. So now I enter into a contract. Okay, I enter into a contract. Okay, I buy crude futures maturing 31st of March, wherein I enter into a promise to buy 1 lakh barrels of crude on 31st of March. Fine. That means I did not have to pay that $5 million which Harsha had to pay. Now Harsha will have to pay, not only pay $5 million, she will have to pay interest on those $5 million for the coming 3 months. I save that part also. Then Harsha cannot, where does she keep that 1 lakh barrel? Okay, she will have to have some go down, some warehouse. Okay, that cost is also saved for me. So Harsha incurred what? Harsha incurred the spot, Harsha incurred the interest, Harsha incurred the storage cost. I saved all three. But on 31st of March, when the crude was supposed to come to me from Abu Dhabi pipeline, there was some damage and I could not have the crude on 31st of March. Harsha is enjoying the day. Why? Because my clients are now going to her. That is called convenience yield. That means convenience yield is basically the benefit of having the physical, which you do not have when you have derivatives. For example, if I have a stock, I will get dividends. But if you have the futures on the same stock, you won't get dividend, because the holder of a future of a stock doesn't make him the shareholder of the company. So the base of this model is that whatever it takes to carry a physical till the maturity date should be the price of the futures. All the adjustment done, okay, to the price. Like for example, if I'm a future holder, I am deprived from that convenience of owning the physical, and hence that part would be deducted. Open interest means unsquared of contracts, Harsha. I hope she understands. Okay, fine. So TF applicable, spot plus interest saved plus storage cost saved minus convenience yield foregone. The TF applicable to stocks. Now, you know what? This is the main equation that came into the market, because futures were first introduced for commodities. People want food, shelter. Initially people were not confident, uncertain about their food, their shelter, and so many basic things, and hence futures first came into the market for commodities. Later on, the same logic was extended to stocks. So when you talk about stocks, what will happen? Spot will be there, interest will be there, the storage cost will not be there. Why? Because we store in demat, and demat has hardly any cost. Then convenience yield in terms of crude would be converted to dividend yield. I hope all of you are fine. Yes. Now you have three formulas. One is like if the interest rates, like same in forex guys, the same when the interest rates are compounded only once in a year, okay, then you will use this formula. When the interest rates are compounded more than once in a year, that means quarterly compounding or something like that, then you'll use this formula, same as we did in the forex chapter. And if it is continuously compounded, if people do not understand this, please tell me. I can record, maybe like I'll try to record guys separately on this, but we should not be wasting time depending on the type of the rates given in the question. Don't worry, when I do a question, no, you will be able to understand. Just relax on that part. Allow me to breathe for a minute. I speak non-stop, nahi? The students in the regular batch keep on telling, ma'am, you speak non-stop. Okay, start. So there is a question number 3. Okay, Mr. X is a senior portfolio manager, okay, at ABC Asset Management Company. We would need minimum 3 lectures for derivatives, guys, and that too if I teach at a stretch for 3 hours, or maybe for 2 hour 45 minutes, something of that sort. Yeah. Okay, fine. Mr. X is a senior portfolio manager at ABC Asset Management Company. He expects to purchase a portfolio of shares in 90 days. However, he is worried about the expected price increase in shares in the coming day, and to hedge against this potential price increase, he decides to take a position. Can you read this question once? Just read this question and come back. Can you do that for me, all of you? Read this question at least 2 times, 3 times, because you will not register if I read this question and start the solution. You will not be able to. So read this question and come back and tell me, ma'am, done. Okay, till the time I get a 1 minute break. Mobile is an addiction, yeah. And I have some OCD related to replying to people. I just can't tell you how much OCD I have got. I have to reply. I have to reply. I can't ignore the messages. Even during the nights, if you see 3 o'clock, if I'm able to, like with the whatever notification, I'll start replying then and then. People, they shout at me at home. If you are done with the reading part of the question, you can tell me, ma'am, done, so that I can start reading the sum for you. Done, guys, all of you? Oh my God, nobody is replying me. Mr. X, everybody. Mr. X is a senior portfolio manager at ABC Asset Management Company. He expects to purchase a portfolio in 90 days. He wants to buy a portfolio after 90 days. However, okay, thank you. However, he is worried about the expected price increase in shares in coming day. That means, so in derivatives, please remember some rules. When you are scared of something going up, buy. And when you want to make money by something going up, again buy. When you are scared of something going down, you should sell. And when you want to make money by something going down, then also you should sell. Okay, now guys, can you give me a seconds, can you give me a please seconds break, because there is something going, kind of some noise is going to happen. So just hold on for 1 minute. Okay, hold on for 1 minute. So here guys, they are saying that he is worried about the price increase. So he should buy futures or buy forward, whatever. Then he says, the index is currently trading at 2290. This is spot value. Assuming that continuously compounded dividend yield is 1.75%, risk-free rate is 4.16. You are required to determine, calculate the justified forward price on this contract. Okay. So the first question. So basically what will you do? You will do nothing guys. Just the third formula, this one. So here, so basically what you are doing, you are removing, you are making the spot X dividend. Okay, if you understand that part, because the futures do not, derivatives does not bring you income benefits. That means if you hold a future of Reliance, it won't give you dividends. But holding a stock of Reliance would give you dividends. And that is why whenever you are computing the price of any derivative like future or option, you will always make it X dividend. I hope you are getting my point. I don't know whether you are getting it or not, because I cannot speak a lot in detail because of the limitation of the time actually. So nothing, just formula wise go, substitute the values, the factor would be given somewhere here. Okay, and you compute the value and you get the price. So this is a 2303.65 is the price of the futures 3-month forward contract. Okay, so I've given you here. And the second part is most interesting. Suppose after 28 days. So what was the original maturity? 90 days. Okay, I was standing here. Suppose after 28 days here of the purchase of the contract, the index value stands at 2450. It is a spot value. It is a spot value on the 28th day. Okay. Then determine the gain or loss on the above long position. Just tell me one answer. This 2303.65, this value mathematically stands for this part after 3 months, right? So tell me something that if you want to square off here, can I do 2450 minus 2303.65? Is it mathematically correct guys? Is it mathematically correct? Please tell me, is it mathematically correct to do like that? No, no. So what we can do, and I don't have a choice also, what we can do, we can go back again here. We can go back again here and calculate the forward rate for 28 days instead of 90 days. Okay, which matures on the 28th day, right? Instead of, yeah, so I go back again to 0 and I calculated 28 days forward. Okay, so that on the 28th day, it becomes a spot. And then I can take a difference of 2450. Look at this. So basically 2290, again they went. Can you see this? They calculate. So you do not buy at 2303 here, rather you buy at 2294 and you sell at 2450. This is your answer. And then in the third part, expiration date is supposed 2470. Now you can apply 2303 because 2470 is a spot value for the end of the 90 days, okay? And 2303 is also applicable for 90th day. So basically, I don't know whether you are able to get that intuition part or not, that you can take a difference between the two rates only when the appropriate interest is given there. Okay, so if 2303 has got 3 months of interest, you cannot take a difference with 2450. It's technically, mathematically non-compatible actually. Okay, that's how. So this is done, guys. Just have a look later on. Then the fourth question is, suppose that there are futures contract on a share presently trading at 1000. Okay, now the life of futures contract is 90 days, and during this time the company will pay dividends of rupees 7.5 in 30 days. So what is happening? I tell you something. So it is like this, then 0, and then they are saying, okay, so this is 30 and this will pay a dividend of 7.5, then this is 60 and this will be 8.5, and at the end of the 90th day it will pay a dividend of 9, okay? And what are they asking you to calculate? The futures price should be using cost of carry model. There is a problem. The problem is that you want to calculate spot into E, I minus dy into n. There are some problems, not one problem. The problem is that here, guys, if you see, I can adjust only one dividend yield. Okay, I can adjust only one dividend yield, and the data of the dividend is not in terms of the dividend yield also, they are in terms of the prices. But the prime agenda of this calculation is to remove dividend from the spot, make it X dividend. So why not compute the present value of this here, and this here, correct? And then subtract from spot. So your S becomes X dividend spot, and then what you can do, X dividend S into E, I into N. No dy is required. Ultimately, you don't mug up the formulas. There are so beautiful logics out there. You don't need to mug up the formulas at all. Guys, did you understand this part? Now look at that. And in order to do that, what they have done, look at, they have given the factors here. So what is the risk-free rate of interest is 12% per annum. Okay, you are required to find out. So minus 0.01. That means when there is a minus, it is a discounting factor. I hope you understand that part. Okay, and then it is why 0.01? Because 30 days. Okay, so if the rate is 12% per annum, do I not get 0.12 into 1 by 12 or 30 days by 360 days? Better, wait a minute please. Into 30 by 360, what would you get? You will get 0.01. Okay, but do you want to compound? No, I don't want to compound. I want to discount because I want to bring 7.5 to 0, and these are the factors given for the same purpose. Okay, so you will apply to 7.50 and so on, and you get a value, guys. This is the value of your dividend, and this amount would be subtracted from this 1000. Okay, and then I think it's quite simple to understand, and then you apply this 12%, okay, for 90 days, and you get the value. Guys, did you understand this part? If you have a doubt, you can ask me. What did we do? I cannot use that original formula of S into E I minus dy into N because dividend is not given in terms of percentage, and we have 3 dividends. Okay, so I will ultimately, what do I want? I want to remove dividend from my spot. I want to make it X dividend because dividends are not applicable for derivatives. I do not get any dividend. So in the pricing, I cannot consider dividend. So remove it. How do I remove? Because they are standing at different points. So just take a PV. For PV, they have given the rates, you can do it. Guys, tell me please, did you understand that part? And you remove this. Just give me a second please. I just want to see whether I get the same answer. 1000. Yeah, I get the same answer. So maybe 1000 minus 24.49, the formula I wrote here. Did you not see it? So this will be what? 1000 minus 24.49, and then take it 90 days ahead. Okay, and then the next question is cost of carry 5.96. There is There's nothing like very complicated about it. Stock futures arbitrage is the next topic actually. Okay, the stock, what is the stock futures arbitrage? I need to tell you that actually. Okay, I'll tell you here only. So basically here what will you do guys, stock futures arbitrage. Give me a second. Give me a second please. Okay, what is the stock futures arbitrage? So step number 1, compute TF. Compute TF. What is TF? Theoretical futures price. Okay. Then number 2, compare AF with TF. Did you understand this? AF with TF. Okay. Then third, case 1, AF is greater than TF. If AF is greater than TF, futures are relatively overvalued and spot is relatively undervalued. Okay, like that. Now case 2, AF is less than TF. Guys, I have a complaint with all the English, this 100% English fast track batch. Okay, all the people, whether they are South Indians or North Indians, I don't care about that. You are studying, you are students, I am your teacher. Okay, you guys are behaving very miser, okay, in terms of commenting. This is for the students who are watching the videos in terms of the recorded format. The live students are any which ways interacting quite a lot, as much they can, okay, but the recorded ones are not doing anything, and I really am like I have a complaint about that. Please comment, please like, please subscribe. It will, that's what, at least you can do that much for me. Okay, please do that. You are not subscribing to the channel, you are not commenting anything after watching the lecture so much. Okay, please do comment whether you liked or didn't like or something. Write down something. Okay, it will be good. I feel more motivated, because if I don't see any response coming out there, you are not coming in the live lectures, okay, and nor you are watching the lectures, not commenting also, how do I know? There is no reciprocation happening actually. So it is a sincere request, please, all of you need to do that. And this has been told by my team to inform you that Hindi batch was very in these matters. Now that is a competition. Okay, the Hindi batch was very interactive. If you go and see the videos, there are so many people who are liking the videos and commenting out there, going out of the way to comment. Okay, it helps in the SEO of the YouTube channel of mine. You please do that much for me. I would be happy. Okay, so if AF is less than TF, futures are relatively, you can write down, thank you ma'am, relatively undervalued and spot is, Viru has not come today, what happened? Relatively overvalued. Okay, so this is what you have to understand. Please be very careful about this. This will help you solve many sums for that matter. Okay, coming back here. Now, the stock futures arbitrage. Okay, the stock of Reliance Energy trades 12. This is a stock price, while 3-month futures on the stock trade at rupees 1290. Before I start solving the sum, we have some adjustment that you need to know. The adjustment is that interest rate and dividend yield you will get. Let me come 2 steps back. If I ask you to compute theoretical futures price, what will you do? Spot plus interest minus dividend yield. Okay, so interest rates are 99.99% of the times given for 1 year. But if I want to calculate 3-month futures, then what will I do? I'll provide a time adjustment. Okay, if 12% is a rate for the whole year and I am computing 3-month futures, then into 3 by 12 is a normal adjustment. But for the dividend yield, it is not that easy actually. So you'll have to follow certain rules in order to do that. One, annualized or DY per annum. You will provide time adjustment. But they say, what are you wanting to do basically? You are wanting to make your stock X dividend. Okay, now listen to me carefully. Now suppose you are standing on 1st of Jan and you are wanting to compute the value of 3-month futures, which is expiring on 31st of March, and the company gives its annual dividend in February only. Thank you, Kriti. Thank you so much. Thank you so much for coming, sweetheart. God bless you. All the best for your exams. Do well. Tell me how was your paper. I'll be waiting for your... Thank you, Kriti. Thank you. Thank you so much. Okay. So what I'm wanting to tell you is that, so guys, tell me, you need to answer that. Okay. If I'm standing on 1st of Jan, the example that I gave you, if the company gives its annual dividend only once in a year and that comes in February, and if I'm computing the price of these futures which will start on Jan 1 and expire on 31st of March, should I, irrespective of the fact that the maturity of the futures is 3 months only, okay, should I provide a time adjustment to that dividend or not? Because I am supposed to remove any dividend component from the price of the stock. Tell me yes or no. Why these people don't respond? Kriti is responding quickly. Other people are not responding. Why? No, you will not provide time adjustment. You will not provide time adjustments. So, they just write dividend yield and do not write anything per annum or annualized. Then do not provide. Then they write annualized dividend or dividend yield per annum Okay, it's okay. Dividend yield per annum, but to be paid before the maturity of futures. Okay, so again, do not provide. So look at here. So basically guys, here find out the theoretical futures price, case 1 1000, case 2 1500. What are the limitations of stock futures arbitrage? So spot is 1200, the given AF actual futures price is 1290. Okay, risk free rate of return is 10%, dividend yield is 1%. Can you see something? They written the stock is expected to provide a dividend yield of 1%. They did not say anything like annual or annualized or something like that, and hence I have not provided any time adjustment, assuming that this 1% is applicable for that 3 months only, and hence no time adjustment. Okay, so you calculate 1218. Now you have actual futures price is 1290 and theoretical is 1218. So now AF is greater than TF. Go back to this the theory part, okay, and you can check it out. Futures are relatively overvalued and spot is undervalued. We sell futures at AF 1290 and buy spot at 1200. That means two positions will get open. Basically you are trying to find out some arbitrage gain because of this mispricing. Because the actual and the, let me shade this, the actual and the theoretical futures are not same, and hence there is an opportunity out there. So what is the opportunity? Your AF is greater than it should be. Should be is 1218, it is 1290. So futures are relatively overvalued. It also means vice versa, that is your spot price, your price in the spot market of the stock is undervalued. Okay, so now here I prepare a schedule here. Okay, I prepare a schedule. This is on maturity, guys. So you sold futures at 1290 and you bought stock at 1200 because it was undervalued. Now it is time to square off. Look at this. Can you see? If nothing is given in the question, then on the day of maturity, okay, you have opened two positions, guys, one in the cash market, one in the futures market, right? But on the day of maturity, theoretically we assume that, like, this is suppose cash market. So this futures market is related to this cash market only. So ideally the futures on expiry and the cash on expiry, the cash price on expiry should be same, because eventually we are talking about the same asset. They cannot be different. But if they give you separate prices for two markets, you will square off at different prices. But can you see that we are squaring off at same prices because they have not given two separate prices for them. So I square off at 1000, that means I sold at 1290, I buy at 1000, and for the stock I bought at 1200, I buy at 1000. Okay, and then same 1500 here, I sold at 1290, I will buy at 1500. In terms of stock, I bought at 1200, I will sell at 1500. And then the interest expense on this stock, basically, I think Harsha, you understand all this, right? So there are very few people out there again. Okay, so I'll just quickly rush off with the topic actually, because I think Harsha is responding and rest of the people are understanding or not, I don't know. Okay, so interest expense, are you getting, guys? You are not telling me. I am just going as per my speed. Are you able to understand? Understanding. Okay, so basically here I see that there is a, actually basic, if you see this now, there are four items here. This is F, S, I and dy, correct? Look at this, the formula. Can you see the formula? Where is that? This one. Four items and four adjustments here. Okay, so here F, S, I and dy. So this is what are you doing basically? You are basically calculating the arbitrage gain. You standing at zero, you decided to sell the futures and buy the stock because you compared AF and TF and you found them mispriced. Okay, so depending on that, you built up some position like selling the futures and buying the stock. Now both the positions are squared off here and here. Then when you bought the stock, guys, when you bought the stock, how many stocks? 250 at a price of 1200. The interest part would be deducted, and because you own the stock, you will get dividends. Okay, so the net amount is 18,000, though you can calculate like this also. Same here also 18,000. You can ask me question, ma'am, when it will not be 18,000? It will not be 18,000 if S and F on the day of maturity are not same. Because if you take a total here and if you take a total here, 72,500 minus 50,000 is 22,500, and 52,500 minus 25,000 will give you 22,500 only. This is constant, these two are any which was constant, 3,000 is constant. So you are going to get 18,000, whatever prices you want to take here is 1800, 900, whatever you take, you are going to get the same answers there because you are squaring off at the same prices. This is a very, very theoretical situation. In practical life, you will not get to square off at the same prices. Futures will be squared off at some other price and stock would be squared off at some other price. Next question, question number 6. Okay. Now, what is cost of carry model in financial futures? Okay, the price of that theory part is written here. You can, whatever I made you understand. Yes, we get different. Correct, Harsha? So what is the cost of carry model? Nothing. I just explained you. That is written in the in terms of sentences. Now, the next one, the price of rupees 100 Wipro stock on as of 31st December 2004 was 520 and the futures price on the same stock was, same date was quoted at 550. So basically 520 is the stock price, okay, and 550 is AF. Other related information is given. Time is 3 months. Borrowing rate is 20% per annum. And this annual dividend on the stock is 15%. One more thing I forgot to tell you is that dividend yield would be applied on market price, MPS. Dividend rate would be applied on face value. And dividend payout would be applied on EPS. So this is dividend rate actually. Can you see the language? This institute sum only. Payable before 31st/3/2005. Okay. So based on the above information, calculate future. This 15 will not be applied on the stock price 520. No, this will be applied on 100. Point number 1. Point number 2, the dividend, whatever is the dividend, okay, you will not provide a time adjustment, though they write annual dividend, but you will not provide time adjustment to that dividend because they are saying that the whole of the dividend is coming within the maturity of the futures and you will have to make your stock ex dividend for the whole of the dividend. I don't know, nobody is asking me a doubt. I assume they have understood. So look at this, 20% into like this one. Can you see that? And now since AF is greater than TF, futures are overvalued and stock is undervalued. We conduct cash and carry arbitrage, that is sell futures and buy stock. Instead of creating the whole schedule, I took the shortcut to compute the arbitrage profit. Okay, again, this question is very important from the exam perspective. You know, it is basically the same sum, no change at all. So rather than getting into the whole detailing, I can tell you something very important in this sum. Yeah, shortcut basically. No, Harsha, you can, basically see the weightage of the question. No, if it is like, suppose if it is like, what do you say? If it's a very high marks question, then you cannot take a shortcut. But yeah, using that, you will be able to know that what should be the final answer. That will help you understand that part at least. Okay. Now here, this question is very important as far as exams are concerned. Suppose current price of the index is 13,800 and yield on the index, this is a spot price actually, and the yield on the index is 4.8% per annum. Okay, fine. A 6-month futures contract on index, I think this is AF guys, this is AF, and 13,800 is your spot. Assuming that risk-free rate of interest is 12% per annum, obviously, show how Mr. X can earn an abnormal rate of return irrespective of the outcome after 6 months. You can assume that after 6 months, index closes at 10,200, and so S equal to F is equal to 10,200 and S equal to F is equal to 15,600, and 50% of the stock included in index shall pay dividend in the next 6 months. So guys, you know what? They are saying 50% of the stock included in the index shall pay dividend in the next 6 months. Do you understand the meaning of this? This means that, you know what? I will not provide a time adjustment to 4.8%. Why? I tell you, this is a 6-month time frame for me while I'm computing the futures price. Okay. So the whole index has been divided into 2 parts. Okay. 50% of stock are paying, 50% of the stocks are paying dividend between January to June, and 50% of the stocks are paying dividend from July to December. But they are paying their 100% of the dividend. So 50% of the stocks are paying their 100% of the dividend during that 6 months, and hence no time adjustment. Okay, look at this. Can you see that? This 0.5 stands for 50% of the stocks. It is not a time adjustment 6/12. Okay, and then you compute. The only difference in this question and the question we did above, they have not considered interest here. If you see here, if you do as per the method I have given you above, they have not computed they have not taken the interest rate here. Why? Because guys, they are asking you to compute the abnormal rate of return, that means the arbitrage percentage. Okay, and they are wanting you to compare, basically they are wanting you to calculate the gross return. When I say gross return, interest part is not deducted. Okay, and then after computing the gross return, you can compare that rate with the interest rate. So if your gross return is greater than the interest rate, arbitrage profit is there. So that is why they have not taken interest here. Correct. So 871 divided by 13,800, this is spot value, 6.31% into 2. So basically here, okay, 6.31%, how much do you get? 6.31 into 2 will give you 12.62%. 12.62% per annum. And what is your interest cost? And interest is how much? It is 12%. So 0.62% is your abnormal return or arbitrage return, whatever you want to say, you can do that. So if you consider interest, you will get only 0.62% net amount you will get. Now we are coming to hedging, guys. We are coming to hedging now. So I have how many questions? I tell you, I have 2 questions in the hedging. Okay, so we can do 3 questions and wind up for today. So if I take a small portions, guys, I will be able to manage, because if I take too much of portion, it becomes difficult for me. Okay, so maybe 9 o'clock I wind up. Okay, any which ways all the students are wanting to watch recorded, so it doesn't matter too much, right? There are various tools of hedging. No cover you have done already, forward cover you have done already, money market cover you have done already, options cover we do later. At this point of time, this is what is important: futures cover. Right? The hedger has an exposure of payable or receivable, and hence he is afraid of currency price going up or down in order to hedge himself. I don't read this. Let's look at the question actually. So question number 8 we are doing. ABC Technologies is expecting to receive a sum of $44 lakh after 3 months. If they are going to receive this money, that means they are exporters and they are afraid of dollar going down, right? Now, the company decided to go for the futures contract to hedge against the risk. Okay, the standard size of the futures contract available in the market is $1,000. Okay, let me read the question. As on date, spot and futures dollar contract are quoting 44 and 45. Suppose after 3 months, the company closes out its position futures quoting at 44.50 and the spot rate is also quoting at rupees 44.50. You are required to calculate effective realization for the company while selling the receivable. Okay, so what I understand is, guys, the question is of receivable, point number 1. And hence you are afraid of dollar going down. In this hedging of currencies using futures, it is a very intricate topic actually. It is a very, very intricate topic, right? So how do you say? Suppose it is rupee per dollar. Okay, so the name of the futures will be as per this, the denominator actually. So if you have dollar exposure, if you are afraid of dollar going down, ideally you should sell dollar futures, but it is not in your hands. Why? Because if the future quotations is like this, then it is a direct quotation. But there could be a possibility that you want to sell dollar futures, but dollar futures are not available only. Rather, rupee futures are available. How come? Dollar per rupee is the quotation given for futures. So how would you think? Since I have dollar receivable, I am afraid of dollar going down. Ideally, I should sell dollar futures, but since dollar futures are not available, rather rupee futures are available, I buy. Because the way you are afraid of dollar going down, similarly, you are also afraid of rupee going up. It is one and the same thing. The way you are afraid of dollar going, it is one and the same thing. Dollar depreciate or rupee appreciate, it is one and the same thing. So maybe you cannot rather fix a rate to sell dollar, but you can always fix a rate to buy rupee. Why not? Yes, correct, Harsha. So here, guys, if you see, okay, if you see here, you are required to calculate the effective realization for the company while selling the receivable. Also calculate how company has been benefited. Okay, so receivable $4 lakh. Be careful. I'll be like lot 1000, futures at t equal to 0, 45, futures on maturity. So basically, are dollar futures available here? I do have. Why? Because dollar is in the denominator. So I sell at 45 and I buy at 44.50, thereby making a profit of 0.5. Expected spot rate is given. So what happens, guys? I tell you something. I draw 2 lines here that will just complete your topic immediately. 0 and how many months? 3 months. This is cash market. Then you have here futures price. Okay, so futures, this is futures market. So this is 45 here. Okay, and this becomes 44.50 here. So basically what you will do, you will enter into futures contract to sell at 45. Why sell? Because I am afraid of dollar going down. When I am afraid of something going down, I sell dollar futures and buy it back. If I were a speculator, I would have gone home back. But my job is not done because I need currency. And in the expected spot market, it is 44.50. So what will I do? I will square off here. Okay, I'll square off here. For example, I gain 0.5 here. I gain, if I sold at 45 and buy at 44.50, then I gain 0.5 here. Correct now? So in that case, guys, my cost will get reduced from 44.5 to 44. Agree all of you? Yeah. So if you do not take any cover, you will go as per this rate. Okay, futures cover. So 400 lots basically. So since the firm has receivable, it is afraid of dollar going down. It should ideally sell dollar futures, and since dollar futures are available, we sell at this. Look at this. You make 2 lakh rupees. 0.50 rupees 0.50 per dollar. Okay, and 400 lots. From where did it come? This one. and then you multiply it with the size of the lot also. And then guys, you will go to the cash market, receive this, okay, and you will, Achha, this was not a payable sum actually, I'm sorry, I'm payable, sorry, it's a receivable sum. So basically guys, you gained 0.5 here, now your inflow becomes 45 actually, 44.5 plus 0.5. It was in my mind, I'm doing a sum for payable actually. Okay, so you are done here. So you earn here. So I'll show you something. 180. Yeah, why don't you do one thing? Why don't you do one thing? So you just divide this complete inflow 180, okay, 0000, divide by 1000, and again divide by 400, you will get a 45 ka rate. The rate is 45, okay, that means you earned 0.5 here and you sold at 44.5, combined together it becomes 45. Yes, Pooja, tell me. You missed out, Pooja? What happened to you? What happened to you? Okay, so guys, let us do one sum at least, kind of, we can complete question number 9 and then we can wind up for today actually. Okay, so because it is already 9 o'clock, we can do very much. Nitrogen Limited, a UK company, is in the process of negotiating an order amounting to euro 4 million. Be careful, okay? A UK company, okay, with a large German retailer on 6-month credit. If successful, this will be the first time that Nitrogen Limited has exported goods into a highly competitive German market. The following 3 alternatives are being considered for managing the transaction risk before the order is finalized. Okay, what I understand here, this question is of receivable, and that is euro 4 million. My home currency is pound. Okay, the next part of the question, they say that the following 3 alternatives are being considered for managing the transaction risk before the order is finalized. Invoice the German firm in sterling using the current exchange rate to calculate the invoice amount. So basically guys, you know what, the spot rate is 1.1750 slash 1. So if it is a receivable, you will use this rate, right? If it is a receivable, you will use this rate 1.17, but I need to see whether the rates are direct or indirect. I cannot say like that. So here the rates are, okay, the rates are euro per pound. So euro sell means pound buy, correct? So you will, did you understand what I said? I'm saying it all depends on the rate that has been given to you. If I'm a UK company, I would have been happy to have pound per euro, but since they are giving euro per pound, and since you have a receivable, you will sell euro 4 million. Okay, can I sell euro here? No, I cannot sell euros, but I can buy pound. Look at this. So the rate applicable to me will be 1.1770, this one. Okay, invoice a German firm in sterling using the current exchange rate to calculate the invoice amount. That means they are saying that why not invoice in your home currency, and for that use the today's spot rate. So basically euro 4 million divided by 1.1770 will be your answer. Oh, correct. I'm so sorry, Pooja. Now, so this is done basically. Then alternative of invoicing the German firm in euro and using a forward exchange contract to hedge the transaction risk. Okay, so you can sell euro forward. Okay, how? Okay. Oh shit. Is he okay now? Guys, they've done some calculation error in this question. Look at this. Can you not see high low? It is like high low, but they have added this. Ideally, it should be deducted. Okay. So what I understand is that the rate has to be deducted actually. Okay. It cannot be added because it is high low, and but they have added. I don't know what they all do quite a few times. Okay, that's good. That's good. Okay. So look at the solution now. So they divided, we are correct here. And look at this, they have added this. You cannot add this, you will have to deduct this. So basically the rate will be the ask rate only for the forward, but it has to be 1.1770 per pound minus 0.0055. Okay. And that is how the answer, there is an alternative answer also. Can I show you that? Look at this. There is an alternative solution. Let us do this only. So you get answer this. Now use of futures contract will be a bit complicated here. Why? I tell you something. Because be careful all of you. You have euro receivable. You have euro receivable. Okay, and hence you are afraid of euro going down. Ideally, I should sell euro futures. Do you have euro futures here? I do not have. Rather, I have pound futures. So I cannot sell euro futures, but rather I can buy pound futures at a price of 1.1760 and square off at the rate of 1.1. That means you will buy. Why? Ideally you should have sold, but there are no euro futures available there. Okay, you have pound futures. So the way you are afraid of euro going down, you are also afraid of pound going up. The way you are afraid of euro going down, you are also afraid of pound. The way you're afraid of euro going down, you're also afraid of pound going up. It is one and the same thing, right? I am good, sweetie. So you buy at this and sell. Ideally, we should have sold. So one thing very important, in order to use, very, very intricate, that is why I'm saying this will be the last sum for today. In order to use pound futures, we call it as per the denominator actually. In order to use pound futures, you need to convert your exposure into pounds. How would you do that? Euro 4 million divided by the futures rate at t equal to 0. Always. Your receivable is euro 4 million. You are afraid of euro going down, right? Thank you so much, Pooja. But yeah, please take care of him. Okay, so basically you are scared of euro going down. Okay, and hence we should sell euro futures today and buy them later. But I do not have euro futures, I have pound futures. Instead of selling euro futures, I can buy pound futures at the price of 1.1760. But in order to do that, I need to convert my exposure of euro 4 million into pounds. How to do that? This rate, always. Look at this, they would have converted here. See, they converted. Now you will divide by the size of the contract. 54 contracts of pound futures, 54 contracts of pound futures, each contract having 62,500 of pounds, okay, would be bought. Now, so bought future at this, sell at this, total profit this one. Take out the profit, guys, here. Okay, take out the profit here. So when you multiply, guys, you get euro again. I don't know whether you understood this or not. Allow me to do something here. The first step is to convert euro into pounds to use pound futures. This is correct. Now convert into lots. Correct. Now From here, I think I'll do as per my understanding, that will be better. Okay, I think I'll do as per my understanding actually. So the point number A will be profit on futures. Profit on futures will be sell price euro 1.1785 per pound minus euro 1.17. The way we do Harsha in the class, that's much easier actually. The whole into 54 contracts into pound 62,500, correct? What do we get here? We get 1.1785 minus 1.1760. Okay, I get, look at this, euro 0.0025 per pound into 54 into 62,500 will give me what are we getting here? Pound 3375,000. Okay, look at this. Is it not the same step? Is it not the same step as this one? It is the same step, right? It is the same. The problem is that you're going to get answer in euros actually. That is the biggest problem. 0.0025 will give you euro 8437.5. I get, they have rounded it off. Look at this. They have rounded it off. Okay, this one. Now the problem is that you gained in euros. You gained in euros. This amount needs to be sold at the rate of this rate on this. You can do one thing actually. You can do one thing. This is a gain for you, right? Why don't you add this amount? So the amount euro is your receivable. Euro is your receivable. You add this amount together and just convert at the rate of the spot rate on the day of maturity, and you are done, guys. Correct. And we are done with the question. So just go through the question carefully. You'll be able to manage this. So, but I doubt they would be asking you a question on currency hedging using futures this time, because they already had asked in May 23 actually. So that is, but I can't say there is no chance of coming. I can't say that, but yeah, the probability is relatively on a lower side because they asked one question of indirect quotation only in the May 23 exams, and hence asking again in November 23 doesn't look like very normal. Okay, but if they do not like to keep a track of the questions, but I think they would be keeping there. It is an institute and it is a, yeah, with a lot of reputation, so like that. So guys, can we wind up for today? Can I wind up all of you guys? We are done for today. So I think tomorrow we can start with a new topic, portfolio insurance using futures. Then I would not be left out with too much in futures. Futures would be over. We can start with options tomorrow. Okay, chalo, bye bye everybody. Bye bye. Harsha, I can't teach 3 hours on YouTube. It is not possible for me because see, in the morning I taught, I mean, I wouldn't want to give a justification because the whole day since 6:30 I am teaching. It's not, again I have lecture at 6 o'clock in the morning. I can't teach so much. And see, look at the number of the students attending live. There are 5 people. I shouldn't be doing only. I shouldn't be doing only. Rather, I would prefer putting a recorded Harsha because see, I get stuck with 3 hours or 2 hours, whatever it is, right? Yeah. I'm going to put now recorded only. I'm not coming live. That's what I would prefer actually. Because see, look at the number. It's only 5 students. It's not wise to be, it is becomes difficult for me, right?